In many countries, it's possible that individuals, and it will be particularly be done by professionals, that individuals will set up their own personal company. Professionals, lawyers, accountants, doctors, architects may earn their professional income through a company, and they either through salary payments or through dividend payments from the company, they will get out of the company the money they need for their personal expenses. In this way, they can, of course, defer the individual income tax on their income, because it's going to be taxed in the company. Countries that feel that in this way these people put themselves in a privileged position may consider introducing a rule where the person, the lawyer, the accountant, the architect, the doctor, will be taxed on imputed employment income. He will be deemed to derive as an employee of his company a particular salary which is pretty much determined on the basis of market conditions. It's a technique that is developed pretty recently in a few countries and seems to work well. The same, much older, is that shareholders may be taxed on imputed dividends from their company, the company they control. And of course, in the case of a professional company, it may very well be possible to combine the two rules. On the one hand, to tax the shareholder who's director and ordinary employee of the company for deemed employment income and deemed return on the capital which is invested in the company. The third rule listed here, imputed income from investment assets, is actually a rule, and you see in the small print at the bottom a reference to NL, Netherlands. It's a rule that Holland enacted some 10 years ago when a new income tax act was put in the books. In the decades before this new rule became law, there was an ongoing battle between the tax authorities and the taxpayers on reducing the tax burden on capital income. In the Netherlands, like in many European countries, capital gains are generally tax-free for individuals, unless the capital gain is realized in a business setting or when the capital gain is realized on shares in a professional company that we discussed a minute ago. So if capital gains are tax-free and ordinary capital income is taxed, there is a obvious tendency to convert income, ordinary income, into capital gains. But that's one important way in which taxpayers often effectively were able to reduce their tax burden. And the countries would react with particular rules countering this particular practice. And well, the tax advisory community usually fairly quickly would come up with alternative approaches that would be beyond the scope of the anti-avoidance rule in the statute. And this sort of alternating battle would be going on all the time. So Holland decided in 2001 to go back to a system that Holland also had in its first individual income tax law in 1892. In 1892, when of course rates were extremely low, were below 5%, in 1892 people were not taxed on the real income they derived from their investments. The tax authorities believed at that time, or I perhaps should say the legislator believed at the time, it was simply impolite to ask a taxpayer what sort of capital income he earned. So at that time they taxed a taxpayer not on the real capital income he earned, but on a deemed return, which was quite low. Well, in more than a century later, we returned to that system. The legislator decided to give up the battle against the continuing creativity on the side of taxpayers and their advisors to reduce the burden on capital income. And they simply said, we're going to value your assets on fair market value, and you're simply deemed to derive a 4% return on that value. And that 4% return is going to be taxed at a flat rate of 30%. To effectively, you're paying 1.2% tax on the net value of your assets minus liabilities, which economically pretty much looks like a tax on wealth, but legally is a tax on deemed capital income. It makes the world very simple, both for the taxpayers when they have to file a tax return, and for the tax authorities that only have to check whether the fair market value of all the investment assets of the taxpayer have been entered into the tax return correctly. Let's move from the instruments developed to deal with anti-avoidance in a very general setting to instruments that were developed to deal with particular cross-border cases where taxpayers in an international setting try to reduce their tax burden. And I've listed here 5 cases that you find dealt with in a number of countries. So we see transfer of residence, and that refers both to individuals who simply move to another country, at least that's what they say they are doing. Transfer of residence by companies, the use of base companies, the erosion of the tax basis, changing the character of income from a less favorable to a more favorable type, and approaches to tax arbitrage, where taxpayers take advantage of the differences in the tax rules between 2 countries. Well, let's take a closer look to each of these 5 approaches. Transfer of residence, emigration. As I said, it applies to both individuals and companies. Well, where individuals are concerned, you have, of course, the case where people really move to another country. I think in the last 2 decades, one sees increasingly in Europe that people, upon retirement, will move from a northern European country, Scandinavian country, Holland, Germany. They will move to a southern country, Spain, Portugal, Italy. A true move. People give up their residence, move truly to the other country.